But anyway, so my name is Areiel Wolanow. I lead lead a small consulting firm called Serve Experts. We are currently engaged with the LMTOM program, and you're here because blockchain is the peak of the hype curve. It is new, it is cool, it is sexy. But I read a great LinkedIn post, it was late January, that basically said, I am tired of hearing from blockchain experts, or people who say they are. There are no blockchain experts. We are all just figuring this out as we go. I've certainly felt that to be the case, and I've been playing with blockchain in one form or another since 2014. I was with IBM for 11 years. I was the first leader of their blockchain services practice in Halcyon. In that role, I sold and then delivered IBM's first non-research commercial consulting engagement, blockchain, which was a trade finance prototype for HSBC and Bank of America, delivered out of Singapore. Worked with several financial regulators and central banks to help them chart paths for blockchain adoption. And then for my very first foray into the London market, was engaged to work with Richard and Charles. Richard and Charles, please stand up. Richard and Charles are the co-authors of the white paper. So tonight, I'm going to be taking credit for all of their hard work. But no, the three of us worked on this feasibility study together. So when I came to this is my first experience at all working with the London insurance market. So naturally, I did some reading, and I read something that was talking about sort of the history of the London market, and what it basically said is the London market is falling behind other insurance delivery vehicles because other insurance are using mathematical algorithms to price their insurance and are increasingly adopting automated methods, while the London market is using processes and ways of working that are many, many years old. That was written in 1870. So it gives you an idea of how long the London market has been dealing with this this kind of resistance to change. So full of fear and panic, I took up this role. So what I'm going to do now is actually remedial, given the number of people who raised their hands said they know blockchain, but I think it's worth doing anyway. In the sense of this is a method that I've been using to explain why distributed ledger is interesting, because ultimately, if the market does decide to adopt the solution that we're putting together, it will not be because it's on blockchain. It'll be because it implements a new business model. And the new business model is what delivers the benefits, not the technology. So most of the people we work with in the market are relatively intelligent, and most of them have heard about blockchain and understand at some level. But I get a lot of questions about about what it does, and so why is this thing called blockchain really worth even thinking about, and how does it help disintermediate the bureau? So I'm going to walk you through how I use a non-insurance example to build an intuitive sense. And my assertion is, if you understand this intuitively, I don't have to tell you the business case. You'll tell me. So this is how I do it. I say so. Let's say, Gary, that you've got a factory and you're making widgets, so you find a buyer for your widgets, and say I'll pick on Kevin there. Kevin, you've got a factory and you agree to buy some of Gary's widgets. So you guys exchange some information, price of the deal. You negotiate a deal in terms of the contract. How many widgets? You're going to buy 10,000 widgets. You're going to send them in. So you trade information, and you guys have never done any business anymore, so this is very much along the same lines of Colladra's network of trust. So you don't, you want to make sure that Kevin has the ability to pay you if you're going to, invest money in building these widgets. So you ask Kevin for a letter of credit. So Kevin goes and talks to his bank and says, I'd like a letter of credit so I can buy the widgets. And does the bank trust Kevin? Of course not. Okay, so Kevin shares some information that, yes, I have the cash flow, I will be able to, and I've got buyers for the widgets lined up. Does the bank trust Kevin? Of course not. So the bank then goes back and talks to Gary and says, did Kevin really do this deal with you to make the widgets? So you exchange some more information, and then says, okay, so the letter of credit is granted, you do the deal. Now you're ready to make the widgets. Well, you don't have money just lying around to buy all the raw materials, so you need to go to your bank and say, I've just landed an order for 10,000 widgets. I'd like a loan so I can buy the raw materials to build the widgets. And does the bank trust you? Of course they don't. So they now have to go talk to you and Kevin and Kevin's bank and make sure that all the details of this are true. I'm not making this up. This actually happens. So then Gary builds the widgets and he's got to ship them. So he talks to the shipper and says, I want you to ship the widgets to Kevin. And of course, the same thing. The shipper doesn't trust any of this. They need to make sure that widgets aren't a dual-use munition. They need to make sure that that Kevin will accept the widgets when they arrive, that the widgets are going to get paid for, or they're taking a risk. And of course, the regulator will step in, and they will want to know everything from everybody, since the dawn of time. So what you end up with is a situation like this, where organizations are spending far more money just talking to each other and changing information than they are in their core value chain. Okay, so poor Gary here is spending more money talking to people than he is making widgets. Kevin is spending more time than he is using the widgets, for his business. Now, of course, this kind of problem always is an opportunity to people. So then somebody will come in and say, look, this is expensive, it's inefficient, it's vulnerable. We can help. So somebody comes in and offers to outsource this whole morass and says, we'll take care of that for you. We will handle all of the communications about the widgets that need to be handled. We'll take it off your hands, and you guys can focus back on your value chain. And probably initially they do. But what happens is, these people are doing this to make money. So their motivation is to deliver the minimum possible for the contract, meet their SLAs, get paid. But you end up with a ever-decreasing level of service at an ever-increasing level of cost. Now, this is the point at which, when I'm presenting this to, not only the market, but people in the LMTOM, people are nodding their heads. Okay, so, yeah, so this is the Bureau. This is what we're talking about. So, by this point, people understand, okay, so now I know why we're talking about blockchain. So then I say, okay, so this is how it works. So instead, Gary and Kevin agree that they are going to, that they are members of, a blockchain-enabled trading network, and they are both going to share a single version that represents this deal that they've done. So when they bring, when they bring in the letter of credit has one place to look for the information to be verified. The supply chain financing, the shipping, and the government all have to look to one place. So, so people start to get intuitively the business case, and by this point, quantifying it and putting the dollars in front of it is largely just an exercise in due diligence. People fundamentally get it. So this is how we build up an intuitive understanding of how blockchain and how DLT is actually going to do what we were asked, which is to disintermediate the Bureau. So let's talk about the LMTOM program. So how many people here know what the LMTOM program is and does? Most of you. Okay, so I'm not going to waste too much time on this. They were given a mission to make it easier to do business with the market because of the belief that the gap between the experience of buying and selling insurance through the London market and sort of the leading edge of where the industry state of the art is, that gap is growing and the market risks losing relevancy. They published a blueprint about a year and a half ago. As many reactions to that blueprint as there are market members, if not more so. But one of the reactions was, it's not enough. You're not tackling the big elephant in the middle of the room, which is the Bureau, and it's hard to believe that we can do this if the Bureau continues to exist in its current form. So they commissioned a feasibility study to come in and ask two key exam questions. Could a new and more effective and significantly lower cost operating model, Simon Gaffney wrote this question, by the way, so give credit where it's due, be created for premium and claims processing between brokers and carriers using emerging innovative technologies? And if so, what would the economic case for this adopting this new model is? Now there were dozens of people involved in one form or another, but Richard and Charles and myself basically led this feasibility study. We created a white paper. Getting approval to release the white paper to the public took longer than the feasibility study itself, which those of you who are dealing with the market again are nodding their heads, and they get this. But the white paper is now available. You can download it. It's on the LMTOM website, and see some of this in more detail than you could possibly care to. So this then is a list of the business services that the Bureau currently performs that if we were successful, we would need to disintermediate. And again, this is not about creating Bureau 2.0. We're talking about a new business model in which there is no central processing capability at all. So there's, all of the processing happens on member-owned nodes. Not just the DLT piece, okay? So the idea is that members would be provisioned nodes in the cloud, okay? And those nodes would have everything they needed to, to do the job that is currently done by the Bureau. So it's a completely decentralized and disintermediate solution. The only things that remain in the center are a small DevOps team to fix bugs, apply security patches. You don't want to count on the IT department of 400 different market members all applying patches at the right time. As well as obviously some level of functional enhancements. And because this will be a private blockchain for the market members, this central organization would serve as the certificating authority. But that's it. There's no actual central processing. There's no central processing capability in the center. Things here. So claims administration. How readable is this? Can you guys read this? I don't want to parrot slides if they're readable. Okay. So a lot of services around claims agreement, transaction processing, net settlement, regulatory reporting, all disintermediated by a solution. So when we started thinking about this, we didn't start with a system architecture. We said, what does a business model look like? How would this actually work? Okay, so the traditional model is a service provider model. Where somebody comes in, and this is a BPO place. So somebody says, we will handle the processing of this business. Okay, so in the service provider model, the driving, overriding imperative is maximize the profit of the service provider. The service provider sees itself, is why the arrows are pointing at the center of the universe. So this is all about, we will satisfy the processing needs to the extent that it is mandated by SLAs in the contract. In my career as a consultant, I've had to deal with plenty of projects that turned red because the service provider saw it as a cash cow and basically committed the minimum level of resource to draw out the most cash. Now I've seen this both from the standpoint of an opportunity where I was invited in to go and replace that service provider, and I've also seen it as sort of a red project where I'm going in and trying to fix the relationship when this has happened. But it's all coming from the same place, is that the motivation is really bound by the terms of the contract. So you say, okay, so we're smarter than that. What we'll do is we will form the members of the market, and again, this is not just insurance, this is anything. We'll form a co-op where the co-op is actually owned by the people who benefit. So you're guaranteed a certain level of strategic alignment. Okay, so now you have a center, but its goal is to take care of the members. So it actually cares about the members. The members are funding this organization. So Lloyd's itself is a co-op, Swift is a co-op, MasterCard is a co-op. So there are many successful co-ops. So this at least takes care of the problem of alignment of goals. Okay, and that's not a small thing, but there are still some problems with the co-op model. And the co-op, you say you give somebody a hammer and all they see is nails. The co-op still sees itself as the solution to the universe. Okay, so despite the fact that they joined R3, Swift finds it very hard to envision and to support a model that disintermediates Swift, that does away with the need to have Swift. And instead we'll put forward solutions where Swift will be at the center of the next. I did some consulting for a company called Giori, which a lot of people haven't heard of. Giori is a Swiss manufacturer. They make the very specialized intaglio printing presses that are responsible for creating about 85% of the world's paper currency. So almost all of the printing presses that print currency in the world are made by this one company based out of Switzerland. And they're trying to think about how they can survive in a new world, and are actually running a pilot of a digital currency project in Uruguay. But that's rare. Most co-ops find it hard to envision a life without the co-op. So again, there's this organizational desire, which is human and utterly predictable, to perpetuate itself. So we really needed to think about a truly distributed model, a model with no center, okay, with no organization who's trying to justify its existence, where the actual onus to change is actually on the members themselves. So that this organization will only grow in cost or scope when the members need it to. The hard part, so when I think about service providers and I think about co-ops, I can provide many, many examples from case studies, both recent and in history. When I was trying to find sort of examples of distributed organizations, very hard, because it's not a model historically that's been possible to implement. The one example I could come up with, pre-blockchain, was GitHub. Okay, when you go to GitHub, for those of you who don't know, is a portal for open source software projects. And when you go, you log in, and it's like a GitHub site, and you can download the open source software you want. But it's not actually one site. Everybody who wants to participate actually hosts their own GitHub content. It looks to the user like a single GitHub site with all these projects on it, but it's actually fully distributed. There's no central GitHub server that's serving up all of this content. But that was the only example that Charles or Richard and I could think of when we were thinking of case studies around this. So it is new, and it's now possible largely because of DLT. It allows us to start thinking about these models in an entirely different way. So this is really, and we did sort of a comparison about what are the overriding objectives, the degree of market control. So here with a service provider, you can only change the way the service provider forms by changing the mandate of the contract. So the degree of control is low. With a co-op, you have strategic direction and oversight, but there's still an immense amount of inertia. Try telling MasterCard, a bank, think about a bank trying to tell MasterCard how to change its processing rules. It's very difficult. Okay. Truly distributed, the community are the only people actually calling the shots, so they have a much higher degree of control. Tendency for central infrastructure growth with a service provider, it's extensive. It grows to justify the cost model. The more they grow, the more they can charge. Very straightforward. The higher quality ones will try to deliver some value in exchange for that growth, but that's certainly not universally true. Here, co-op is still extensive because it grows to justify the existence of co-op. Minimal with a truly distributed because it only grows when people need it to grow. Cost of ownership trend, obviously. You can see impact from new market entrants. Okay, so if you have a service, you have a service provider, and they're providing, their contract that says we will provide this service for 400 market members, and you want to bring 401, or you want to open up a center in Singapore or a center in Brussels. So okay, well that's a change, and there will be new transaction fees and so on and so forth. Here, with a truly distributed model, you just you spin up a new node. So the cost of changing the composition of the market or providing more service is better. Degree of market consensus required. This is probably the one area where a truly distributed model is bad or is worse. Okay, so here, if you've got a service model, you can, with some level of executive authority, say, okay, we're going to change this. Here, you've got to get a reasonable amount of consensus to change it. So it's one place where a distributed model does less well. Implementation risk. Here, it's obviously higher because we're dealing with a new technology. So no question about that. Operational risk, however, is much lower. So one of the problems with the Bureau is there is an ever-decreasing level of expertise. All of the people who were there and had actually a pretty high level of confidence and expertise, they're retiring or they're moving on. And the Bureau is finding it very hard. They're hemorrhaging people right now. They're finding it very hard to keep the level of knowledge that made all these manual processes work. Okay, and it wasn't, I mean, the Bureau is expensive, but at least historically speaking, it did its job because they had people who really understood the market. That is becoming less and less true. Okay, so if you can automate and distribute this to where the members actually have a lot more control of what's going on in their own nodes, you're going to get a lot. Your error rate is going to be a lot lower. We think that we can get rid of at least 90% of the queries that the Bureau currently issues just by distributing and automating these processes. So a detailed walkthrough of how it works then. So right now, brokers and lead carriers and followers all interact with a set of Bureau systems. These are mostly green screen mainframe systems. And there's a lot of reconciliation. There's no one single record of the truth. Every member of the market has their own ledger, their own view of the market transactions, different ways of tracking them, different ways of controlling the workflow or the process through claims agreement or transaction accounting. And the Bureau is responsible to keep them all in sync. Okay? And in this distributed model, there will be a single shared ledger of all market transactions for both claims agreement and for transaction accounting. So there is no reconciliation required. There's no matching required. It's all there. So the number, so not only is it faster and more transparent, but the number of queries, the number of errors should go way down. Is this all making sense? Am I sort of going at the right speed? Okay. Richard, Charles, you want to add anything to this? All right. So what's in scope? What do we actually look at? We looked at insurance transaction accounting and financial accounting flowing through to net settlement. Looked at claims starting with first notification of lost all the way through the claims agreement process, including a level of transparency not currently available, where the insured can actually say, what is the status of my claim? That's actually a very hard question to answer right now. Okay, part of that is just syndicated risk. If you've got a number of followers, that complexity is usually shielded by the broker. He says, I've got you covered. But ultimately, you'd like to, the claimant would like to understand what the status of the claim is. If it's going to take, as is the average in some lines of business, 900 days. Okay, that's not great, but at least if somebody knows, they can plan accordingly for when that claim is going to get paid. Then finally, obviously, there's a responsibility to report some regulatory. So that's placement is not part of this. So this is all post-placement. There is a PPL project that's looking at modernizing placement. They are having some success and some challenges in adoption, as you'd expect. It does include transaction accounting support for delegated authority and prompt treaty as another input into it. So it does handle all of the complexity around the different lines of business with fully syndicated risk. And it should handle all of the reinsurance use cases as well. All right, so I don't want to call this an architecture. It's a solution component map, and it was done very early on. The only thing I can guarantee about this is that it's wrong. But it's a starting point, and it facilitated a conversation with some of the more technical market members about how this might work. So the idea is that you would have an operating node that lived in the cloud that was, and those nodes were owned by the members, but provisioned by this certificating authority. So a new member joins, and we say, we'd like to spin up a node, and we create the node for you. But the node doesn't just include DLT. It has a lot of other pieces. Many of the markets have made a lot of investment in, both in terms of business process and in terms of technology, supporting certain standards. So in the case of transaction accounting, that would be accord messages and the Rush-Lacan process. So we don't want to leave, we want to protect that investment. Our job is to help the market members. So we will have full support for, sort of a service layer that supports Rush-Lacan, possibly with a workflow manager to facilitate that, and a message management gateway that allows, market, the IT systems of members to communicate. There's no messaging needed inside here. That goes away. We've got a single ledger. But to communicate to the outside, we'll still need some messaging capability. Obviously, we want to be able to expose via public APIs the native services. So all of the capabilities will be accessible directly via an API for people who want to go faster than RussellCon enables you to do. And because the market has a very, the set of market members is very heterogeneous, there are still single-person brokers who are market members. We also need every single capability exposed via a UI, so people can can input transactions directly in via a website or a mobile app where appropriate. All of this needs to integrate with a settlement solution. The settlement needs to support both Lloyd's and company business. So obviously Lloyd's settlements goes through STSO. That's a huge value add that Lloyd's provides. The settlement is backed by a central fund, so you make sure it happens. On the company side, there is no central fund. So if an individual member fails to make a payment, you have to rerun the entire settlement again with that member out of the equation in order to make the settlement run. So we need a settlement manager that supports both kinds. Also, an increasing desire from members, both brokers and carriers, to flag some transactions for direct settlement. So not to be netted, but just to be paid right out to the payee. So we need to support some fairly sophisticated and modern requirements around that. So we'll obviously have transaction services that model all of the transactions, supporting the public APIs. Query services, we'll have to have a query data manager. Very, very heterogeneous data environment. We've got the ledger itself. Then we've got the sort of things that distributed ledgers are bad at storing, but are common particularly in claims. Photos and videos and media files of various sorts. We have information that we can't store on ledger because of GDPR. There's right to be forgotten. So if you were to store any identifying customer data, you can't store it on the ledger because the ledger is immutable. You have to store a link to it and have the actual information off. Now the ledger should be the only place you can get the link, so you still get all the the protection and the data visibility rules around the solution, but you can't store it on there. We need to keep read-only caches of all of the open contracts and claims that are currently in the bureau, because claims can be made 30 or 40 years after, as anyone's been in the market is fully aware of. So we need read-only caches of previous data for long-tail claims. And then finally, because ledgers, at least the current generation of distributed ledgers, are not very well optimized for queries, we'll need to keep a cache for acceptable query response time. So if somebody comes and makes a first notification of loss against a claim, the initial retrieval might take a long time, but if we keep a copy of it in cache at that point, for the rest of the 90 or 180 or however long the claim is actively worked on, you should be able to get a rapid response. So we'll have an identity monitor. So these are fairly straightforward. A smart contract which handles some of the state model, if you will. Some consensus algorithm. Consensus here will include not only this sort of traditional blockchain consensus, almost certainly not proof of work. This is a private blockchain, but we'll have some notion of consensus-driven right to transact. But there's another piece of consensus here which is validated the content, which will be limited to only the parties that are actually participating in the contract, who partake. So there's really two parts of the consensus model here. As I said, off-ledger blob storage, a DevOps service, and some reporting. So that's an initial view of how we're thinking about the solution. This will almost certainly morph over time. And then the last thing before we go to Q&A is just the idea of data visibility as we think about it. And this is, this is independent of what kind of DLT. So we did a technical evaluation as well of DLT platforms, shortlisted two and we'll accept either in terms of solutions. The two we shortlisted are Hyperledger and Corda. They obviously have very different ways of implementing data visibility. So this is just a usage pattern. It's not a technical implementation. But we have an idea that an individual user or an automated process can be a member of one or more organizations. If you think about a loss adjuster, he might work for 5, 6, 7 different carriers. Okay? At any time, he's only representing one carrier. Okay? Likewise, an individual person may have the skills or the qualifications to perform a number of different job roles, but at any time, they're only performing one role. So the access to the data, so the data by default is encrypted and not visible by anyone. The keys to unlock visibility to a given cell of data is obtained by an intersection of role and org. Okay? This is actually very important because nobody wants to enable cross-market access. Okay? This is a way of preventing, it's not only a way of enforcing the right level of security, but they also don't want regulators doing phishing expeditions. So if a regulator wants to look at some broad base, they may have to issue 400 different subpoenas to get the records. And they can, that's fine, but they have to be specific about the data that they're asking for. They can't just go in and do a broad-based query. And all of the queries like that would themselves be recorded on the ledger so you could see who was looking at what with the abilities. So that's sort of the CAN vision. Last thing I'll do is tell you where we are in the process now, and then I'll open it up for questions. So with this radical of a business model, we had to think long and hard about how we define requirements. So if you're doing requirements in a traditional waterfall methodology, you would hold a joint design workshop and you would bring in people with the SMEs with the appropriate views and voices, and you would workshop up a requirement spec of some kind. If you were doing this in one of the agile disciplines, you would come up with a list of story cards or a product backlog. Okay, none of those are going to work because, as I said, case studies around distributed business models are not thick on the ground, and people don't have a lot of practice. We came to the conclusion it would be a much better way to go about this, to actually build a prototype, put it in people's hands, and say, can you envision working with this? What would work about this? What doesn't work about this? Do it as an iPad app rather than as a website, so we could put it in people's hands because research has shown that people engage much more emotionally, and they get more involved if you put something physical in their hands than if you just say, send them an email and say, here, go to this website and tell me what you think. So in that sense, the prototype is just a design tool, okay? It is not the first step of a production solution like prototypes so often are. In fact, because there are no NFRs, no non-functional requirements, we are specifically enjoined. We may not promote any of the prototype code into production. So it is only a design tool. We've shortlisted a number of solution providers who are going to participate in that prototype, and they're each going to build their own, and at the end we'll select one or maybe more than one that we will use as the basis. Completely separate, when we get to the point when we're ready to do an MVP pilot in production, we'll do a full legal tender. So this is really, so we're right now writing all of the design for the prototype. That's where we are. So we will do that prototype. We will select the best ones to use and engage with the market members with that prototype to do a formal requirements definition, and that will form the basis for going to MVP pilot and production. Right. Questions? Comments? Anybody? Yep.
One of the earlier slide.
Okay. This one?
Yeah.
Okay.
That message management gateway.
Yep.
Will it allow members to continue to use the existing messaging mechanism?
That's the idea. It's to protect the market, the market's investment in that. It's called TML for those of you who are familiar with the market. We don't want to undermine investment, whether it's in supporting Rush Lacan or even the messaging around ECF. Obviously, we will be replacing ECF, we'll be replacing class, but we hope to basically protect the investment that market members have made in existing APIs, where possible.
So you're talking about USM, SCM, and those messages?
USMs are going away. There are no USMs.
They're replaced by the bot and ECOD.
Yeah, that's right.
Yeah. But that is being replaced at the broker end. At the carrier end, they are not getting replaced.
Yes, they are. No, that will be replaced. But there's a messaging framework, at a technology level that people are using to pass messages. We don't want to tell people they have to implement a new messaging framework to the extent that we can support it. Richard, do you want to talk more about this?
No, I think that,
Okay.
that's the point. Is
Okay.
that the database, the discrete database, gives you the ability to extract whatever information you want about your business.
Yep.
The APIs associated.
Anybody else? Other questions? Yeah.
How do Exchange and DXC feel about this?
To quote the Facebook relationship status, it's complicated. DXC, I think they understand that that life as usual cannot continue. And DXC is not just exchanging; it's not just the bureau. They're a large system integrator. The more enlightened people in there would like to think that they can take the market expertise they do have and be considered a viable competitor to implement this new solution. Perhaps the more interesting conflict actually comes from the associations, who get some of their funding from the current joint venture. Now, when we put together the business case for this, we assumed that the associations would still get their funding. So we took the amount of funding and credited it, so that we're not trying to rob the associations of their bacon. But the funding mechanism comes from the bureau right now, and I don't think that there's a full realization. And so I think there's a lot of fear operating. So like I said, it's complicated. I think that we're getting a lot of different reactions, even within one organization. I'm sorry. I'll get you next. Go ahead.
Seems like to me, in your presentation, at the core is the smart contract component, especially from an automation perspective.
Mm-hmm.
Right? What's your view, or I know it's probably too early, but from a prototyping perspective,
Mm-hmm.
is that leading you to one type of technology, whether a chain, whether that's Ethereum or?
Well, okay, so we did an evaluation of DLT platforms, and we chose two. We shortlisted two, which are Hyperledger and Corda. We actually removed Ethereum because we don't think they have the ability to support it and provide enterprise support. I know they've announced the Enterprise Ethereum Alliance, but we saw more smoke and mirrors than real substance there. We are fully aware that every major breach and problem that DLT has had so far has not been from the blockchain itself, but from loopholes and faulty implementation of smart contracts. So we are obviously and we're dealing with by nature a very risk averse.
This is going to be private though, right?
Yes, it is. But we're dealing with a very risk averse organization. So we obviously don't want to expose the market members to some of the risks that we've seen through some of the failed ICOs and the DAO hack, et cetera, et cetera. On the other hand, as you say, smart contract is really going to be a key part of removing the need for reconciliation. So we're not going to avoid it entirely. All I can say is that as we design the solution, we'll have to use it judiciously. Does that answer the question?
Yeah. Right. You're envisaging a closed garden here for the members of the London market. How do you see it plugging into other systems like B3I?
So the ledger is a shared ledger between the members of the market. We do envision that that this solution, as I said, UI is core to it. Parts of that UI we would like to expose beyond the market, particularly around claims, so that people can see where the hell is my claim and when is it going to get paid. So there are parts of this that will be exposed, but we would expect only market members to own nodes because it's their ledger. It's not the ledger of the insurer, the policyholder, or the claimant. It's the ledger of the brokers and the carriers. But to the extent that it improves the end customer experience, which after all is the whole point here, we will expose parts of it beyond.
But the way I understood this question is...
Sorry.
I was going to suggest, because we're running a little
Okay.
bit late, we can just hold it off. We're just going to switch into the panel mode. If it's something that you think is going to be of value, let's reintroduce
So it's
it.
just about this point, I think it's the interoperability
Yes.
with other platforms.
Well, so interoperability with the member IT systems, as I said, is really core, because, you know, we need to protect their investments. So if, you know, a critical mass have invested in something like a Core or Rusticon, or even ECF, God help us, we'll support that and protect that investment, so that they can use their existing APIs. Beyond that, we will expose the, you know, the public APIs of the solution itself.
Thank you. Right, I think a round of applause is going to Okay, so